You're watching John A.G. Briefing, the desk that does not run on advertiser money, the desk that does not soften the data because it makes you uncomfortable. Spot silver is trading below the $70 level as I record. That is the price. What I am about to walk you through is not. Stay with me. Over the next 48 hours, the silver market could receive more market-moving information than it normally receives in several weeks. Most investors are focused on the price. Most headlines are focused on the price. Most social media discussions are focused on the price. That is usually where mistakes begin, because major moves in financial markets rarely start with the number everyone is staring at. They start with the data sitting underneath it. Right now, institutional traders are watching inflation data, Federal Reserve policy expectations, Treasury yields, COMEX inventories, ETF positioning, industrial demand trends, and physical silver flows. Those are the variables that move billions of dollars, and those variables are all moving at the same time. The silver market has entered one of the most important decision windows of 2026. The question is not whether silver is below $70. The question is whether the market is correctly pricing what comes next. Because while many investors see weakness, others see something very different. They see a market that continues operating in deficit. They see a market where physical inventories remain closely watched. They see a market where industrial demand continues reaching historically significant levels. And they see a Federal Reserve that remains the single most important force influencing capital flows across the global financial system. That is why this briefing matters. That is why the next 48 hours matter. And that is why investors should pay attention to more than the headline. Let's begin with the Federal Reserve. Every silver investor eventually discovers the same reality. Silver is not simply a precious metal. Silver is a monetary asset. That means interest rate expectations matter. When investors believe rates will remain elevated, precious metals often face pressure. When investors begin anticipating easier monetary conditions, precious metals frequently attract capital. That relationship is not perfect, but it is powerful. Recent Federal Reserve communications have reinforced one message. Future policy decisions remain heavily dependent on incoming economic data. That places enormous importance on inflation reports. Every CPI release now carries implications for bond yields, currency markets, and precious metals. A stronger inflation number could force markets to reconsider expectations for future rate reductions. A weaker inflation number could strengthen expectations for policy easing. Both outcomes matter. Both outcomes influence silver, and both outcomes are arriving during a period when physical market conditions remain unusually important. The next piece of the story is supply. According to the Silver Institute and Metals Focus, the silver market remains in deficit. That statement deserves attention. A deficit means the world is consuming more silver than it is producing. Normally, markets solve that problem. Higher prices encourage higher production. But silver is different. Most silver production comes as a byproduct of mining operations focused on other metals. Copper mines produce silver. Lead mines produce silver. Zinc mines produce silver. Gold mines produce silver. As a result, silver supply does not respond as quickly as many investors expect. Even if silver prices rise significantly, new supply cannot appear overnight. New projects require financing. New projects require permits. New projects require infrastructure. New projects require years of development. The supply side therefore moves slowly. Demand can move much faster, and demand is where the story becomes even more interesting. Industrial demand remains one of the strongest pillars supporting the silver market. Solar manufacturing continues, consuming enormous quantities of silver. Electrical systems require silver. Electronics require silver. Semiconductors require silver. Advanced technology applications require silver. Artificial intelligence infrastructure indirectly increases demand for technologies that rely on silver. Industrial buyers do not purchase silver because they are bullish. They purchase silver because production requires it. That distinction matters. Speculative demand can disappear quickly. Industrial demand tends to be more persistent. The market is therefore balancing monetary demand and industrial demand simultaneously. Very few commodities occupy that position. Now, consider inventories. Many investors focus on total inventory numbers. Professional traders often focus on available inventory. That difference is important. COMEX registered silver inventories represent metal available for delivery. Market participants monitor those inventories because they provide insight into physical availability. When inventories become a larger topic of discussion, traders begin asking different questions. How much metal is available? How much is already committed? How much flexibility remains within the system? Those questions become increasingly important during periods of strong demand. No one variable determines price, but inventory conditions help investors understand the broader structure of the market. The next factor involves investor psychology. Markets do not move solely because of fundamentals. Markets move because of expectations. If investors expect stronger inflation, they position accordingly. If investors expect weaker growth, They position accordingly. If investors expect monetary easing, they position accordingly. The silver market currently sits at the intersection of multiple competing narratives. One narrative argues that slower economic growth will reduce demand. Another narrative argues that persistent deficits and long-term industrial trends will continue supporting the market. One narrative focuses on short-term weakness. The other focuses on long-term structural conditions. That disagreement explains why analysts remain divided. Some institutions see substantial upside potential. Others remain cautious. The gap between those views creates uncertainty. Uncertainty creates volatility. Volatility creates opportunity. That brings us to the physical market. Physical silver investors often pay attention to factors that receive little coverage in mainstream financial media: premiums, inventory availability, dealer demand, retail buying activity, large delivery requests, warehouse movements. Those indicators may not appear on television every day, but they help investors understand conditions beneath the surface. Physical markets frequently tell a different story than futures markets. Sometimes both markets move together. Sometimes they do not. That divergence can become important. Now consider the broader economic backdrop. Government debt continues expanding. Interest expenses remain elevated. Inflation remains a central concern for policymakers. Geopolitical uncertainty remains present. Global supply chains continue evolving. Each of those variables influences investor behavior. Each influences demand for precious metals. Silver does not exist in isolation. It exists within a complex financial ecosystem. That ecosystem is constantly changing. The next 48 hours represent a critical checkpoint. Inflation data will influence expectations. Federal Reserve communication will influence expectations. Bond market reactions will influence expectations. Currency movements will influence expectations. Silver will react to all of them. Now let's examine the bearish case. Every serious analysis requires one. The bearish argument begins with economic growth. If growth slows significantly, industrial demand could weaken, manufacturing activity could decline, technology spending could slow, solar installation growth could moderate. Those developments would create headwinds. Higher real interest rates could also pressure precious metals. A stronger dollar could reduce international buying power. Investor demand could cool if inflation continues moderating. Physical demand could soften if economic uncertainty intensifies. These are legitimate risks. They should not be ignored. The bear case exists. The data supports taking it seriously. Now consider the bullish case. Supply deficits remain. Industrial demand remains strong. Long-term electrification trends remain intact. Solar demand remains significant. Investment demand remains active. Physical inventories remain closely watched. Monetary uncertainty remains elevated. Government debt remains historically large. These factors continue attracting attention from long-term investors. The bullish case also exists. The data supports taking it seriously. This is why silver remains one of the most debated assets in the commodity sector. Strong arguments exist on both sides. Strong data exists on both sides. The next major move may depend on which narrative gains credibility first. That is exactly why the next 48 hours matter. The market is searching for direction. Investors are searching for clarity. Analysts are searching for confirmation. The upcoming data could provide some of those answers, or it could create even more questions. Either outcome would matter. Here is what matters most tonight. Silver remains below $70. Inflation remains a market-moving variable. Federal Reserve policy remains a market-moving variable. Industrial demand remains strong. Supply deficits remain part of the conversation. Physical inventory conditions remain under scrutiny. Institutional forecasts remain divided. The next major economic releases remain critically important. The market is entering a period where headlines can change rapidly. Narratives can change rapidly. Expectations can change rapidly. The investors who focus on the underlying data rather than the daily noise often place themselves in a stronger position to understand what is happening. That is the purpose of this channel. Not prediction, not promotion, not hype. Data, sources, verification, and analysis. This is John A.G. Briefing. The desk that does not run on advertiser money. The desk that does not soften the data because it makes you uncomfortable. Watch the inflation reports. Watch the Federal Reserve. Watch the physical market. Watch the inventories. Watch the demand trends. Because the next chapter of the silver story may already be unfolding underneath the headline everyone else is watching. Until the next briefing, follow the data wherever it leads.